I've been breaking a sweat over this last week with everything going on in the markets. And wow, there's been a lot. So I think today, finally, I can actually share some good news with everyone and say that, wow, the market is finally bouncing back a little bit. The markets opened really hot this morning. Markets bounced back. I mean, I saw the S&P was right around 4%. The last I checked, if I look at my watch right now, it says it's 10:48 a.m. So I don't know what'll happen throughout the rest of the day, of course, but as it sits right now, the S&P 500, it's dialed back a little bit, but it was up still about 2.6%. And a lot of the good news and the market reaction so positively, again, comes around the tariff conversations, right? We've been talking about tariffs for weeks now. They've really been a hot topic that's been top of mind for a lot of folks, myself included. It's been very muddy waters navigating through such a quick pullback. And again, this was somewhat of a surprise to myself because the economy overall as a whole still looks very healthy. And while we were definitely overdue for a pullback, I wasn't expecting it to pull back as much as it did. So, I mean, we're still seeing the market down from its high at about 11% roughly. So, we are still in correction territory, absolutely. But it's good to finally see some good news. So, let's break it down a little bit and talk about what this means. So, the Trump administration came out this morning and said, hey, we're going to consider a 90-day reprieve on a lot of the tariffs that we've been talking about. And I'm not overly surprised about this decision made by the Trump administration. We've been hearing internally that a lot of the tariff conversations and a lot of the implementation of tariffs wasn't necessarily to actually implement them. It was to start opening the door for conversations and bring different countries to the table and just have talks, right? That was really the biggest thing. And you can agree or disagree with Trump, right? That's not what this video is meant to talk about. It's just meant to talk about what happened, the strategies behind it, and what can we do as individual investors moving forward. So the biggest, I guess we're one of the quickest responders to the tariff conversations is Japan. Japan actually looks like it's on the fast track to come to some sort of agreement with the United States, which is always good to see. Japan is a close ally of the United States, and I'm not surprised to see some countries like Japan. I think a lot of other countries are going to follow suit where we will see more negotiations. And again, I do believe that a lot of the tariff conversations were designed to ultimately not necessarily enforce them or enforce them to its fullest effect, maybe a partial effect. But again, just bring people together and have conversations. One of the biggest things that probably likely will stick is if there's been any sort of loopholes that countries have taken advantage of throughout the years that just haven't been addressed or just were never closed. A perfect example is China. China has some of the highest tariffs that we've implemented as a country onto them to bring their goods into the United States. And China has come up with some creative ways to circumvent a lot of these tariffs. One of the most notable ways that China has circumvented US tariffs are by creating a Chinese company and then moving the manufacturing plant or moving its base of operations into another country such as Vietnam. Vietnam historically has had very low tariff rates compared to China when importing goods into the United States. And China has said, well, Vietnam is not too far off, geographically speaking. Why not just move our base of operations to Vietnam? It's still a Chinese company, and all the profits are coming back to China, the Chinese people, the Chinese businessmen and women, but we're paying a much lower rate because we're just saying that we're in Vietnam, even though really we're in China. So a lot of tariff loopholes like that, I think, are more likely to stick. And more likely, I mean, there's a very strong chance. I don't think Trump is going to back off of removing any of the tariff loopholes. And there are other ones out there. I'm just saying China specifically because they're one of the largest countries that we import goods with. And because of that, they're probably one of the most clever countries in terms of how to deal with tariffs, right? It's almost like when us as taxpayers see any sort of legislation the IRS has pushed out and say, aha, maybe there's a loophole we can take advantage of. Maybe we can skirt in some extra deductions here and there. Maybe we can defer paying some taxes by kicking the can down the road, right? There's a lot of loopholes even within the IRS code that everyday American citizens take advantage of. And, it's going to be a part of any power that's currently in Washington, D.C. They're always going to look at situations where how can we close loopholes, right? I think where we'll also see some tariffs stick is, remember, we are in the final year of the Tax Cuts and Jobs Act. This legislation was passed in 2017 and took effect in 2018. And this was a major overhaul to the US tax system. And one of the provisions, which is pretty rare, we don't see this too often in other legislation, but one of the provisions we saw that was implemented was a sunset clause. And all that means is that if Congress cannot agree to continue the current legislation or the tax code, come up with a new tax code altogether, by default, our tax code system will revert back to the way it was in 2017. And this was really done due to the fact that a lot of people sitting in Washington, D.C., a lot of politicians said, hey, this might work for us, but it may not work for future politicians sitting in DC. It may not work for future generations of American citizens. And we want to have a fail-safe to revert in the event that we can't come to some sort of agreement, because we all know that coming to an agreement down in Washington, D.C. is also pretty rare. So I think a portion of the tariffs are likely to stay just due to the fact that Trump is looking to generate additional revenue, because he does want to extend a lot of the tax legislation as it stands today. We're sitting in a all-time historical low of U.S. tax rates. And this might not apply to everyone, of course, but on average, Americans are paying lower income tax than they ever have before in U.S. history since when taxes first came about in the early 1900s. So I think some of the tariffs, again, they're going to stay because Trump wants to close loopholes, and B, he wants to generate revenue and not necessarily generate it directly from U.S. citizens, but try to generate revenue from corporations that are overseas, whether they're domestic corporations incorporated overseas, or if they're just straight up international companies altogether importing goods into the United States, and he wants to collect revenue from them. So with that in mind, right, it's great to see the markets bounce back a little bit today. We're definitely not out of the woods yet. There's still a lot of uncertainty around what's happening with tariffs. It's great to see that the markets are climbing back a little bit. In terms of opportunities of where investors can really look, I guess the sectors or style of stocks that really got hit the hardest are the growth-based stocks. I think large cap growth, mid cap growth, and small cap growth stocks. In particular, the Magnificent Seven, which carries tremendous weight across the US stock market as a whole, also got hit very hard. So as these Magnificent Seven companies start to rebound, we'll see the markets pick up a lot of steam just from those seven companies alone, because they carry so much weight to the S&P 500 index. That doesn't mean that other growth-based companies can't also do well too. Again, I think there still is a lot of opportunity outside of the Magnificent Seven. I think just the overall S&P 500, as volatility continues to calm down, that should recover. Mid cap growth stocks, small cap growth stocks. Think of the companies you've probably never heard of before, but are listed on an exchange and have great growth potential over time. I think that's where investors can look, especially if you've been thinking about, how do I reposition myself? Nobody likes logging into their account or seeing their end of month statement come in the mail and saying, wow, I'm down 10%. I'm thrilled. Nobody's ever going to say that, right? Everyone's going to look at it and be like, wow, this stinks. What can I do to make it better? And one of the things to make it better is just look at your allocations, right? Look where there's opportunities. Maybe if you're concentrated in international equities, or maybe if you're concentrated in value stocks, you may want to consider repositioning into growth-based stocks. Again, this is not me saying let's all jump into growth-based stocks. You have to make the decision that's ultimately best for your investment strategy, financial plan, and risk tolerance. But these are just some of the opportunities that we're seeing. In addition, we've talked a little bit about some tax planning opportunities. In particular, we talked about tax loss harvesting. If you want to learn more about that, I believe I talked about it a week or two ago. I sort of covered it in both videos. So if you're interested, look back at the prior 2 weeks of videos, and we talked a lot about tax loss harvesting. I want to dial in a little bit on Roth conversions. So Roth conversions, what those are intentionally taking money out of a pre-tax retirement account. Think money you've already gotten a deduction on. It's growing tax deferred, but when you pull that money out, you'll pay taxes on it. Roth conversions are intentionally taking money out of that pre-tax account, paying the taxes on it today because you don't want to deal with paying the taxes later, and putting them into a Roth IRA so you never have to pay taxes on them again. The reason why down markets really benefit the strategy of Roth conversions is because, let's say I have $10,000 in my traditional IRA and I want to convert it to a Roth IRA, right? If I pull that $10,000 out, I might pay 20% in taxes. So let's say $2,000 in taxes, right? Now the market's down and my account is now worth $8,000. My investment strategy is not changed. I'm not selling anything. I'm just moving my investments from point A to point B, right? Instead of it being worth 10, it's worth 8. And when I convert that $8,000, aha, you're catching on by now. You know that you're going to pay less taxes, right? 20% of $8,000 is much less. That's $1,600 instead of $2,000. So just by the market being down, I saved myself $400 in taxes, and now I have an account that should likely recover in time, and I never have to pay taxes on it ever again. So there's definitely silver linings to down markets. I know when you look at the headlines in the news, there's never any positivity when it comes to down markets, right? There's always doom, gloom. We're in a recession. We're in a depression. What's next going to happen? What's this going to happen, right? That the news is going to talk all negative because ultimately at the end of the day, they're companies too, and they have their profit margin to worry about. And some of the companies might even have shareholders to worry about. So the things that they're going to be talking about are really to attract eyeballs to read their articles, to view their videos, to read whatever information they're pushing out. That's their end goal. And again, we're not here to say whether that's right or wrong. You know, ultimately they are a company, like I said, and they have their profit margins to consider and they have employees and overhead to pay. So that's just the strategy they're going to implement. You know, I always like to take a non-biased approach. It's very difficult in today's age because news articles are really shoved in your face. I've been having a lot of clients and friends and family sending me articles or Instagram reels or TikTok videos or whatever, right? I've just been receiving loads of information from all different sources. And I totally understand that it's challenging to sort of piece through the mess and say, what's true, what's not true, what's overhyped, what's underhyped, and how can I take the information that's accurate, that takes emotion out of the equation so I can make good decisions for my own financial plan. So again, as a quick recap, the markets are back up today. We're definitely not out of the woods yet, right? Tariffs are still in talks. And until they're out of talks, we just don't have a level of certainty that we can feel quite comfortable with yet. But on the flip side, there are opportunities to maybe consider looking at growth style stocks or considering some tax planning opportunities like Roth conversions. So with that in mind, thank you so much for tuning into today's video. I'm over the moon that I actually get to come to everyone today with some good news. I always hate being the bearer of bad news, but sometimes it just comes with the territory. So always great to share a little bit of good news today. We'll keep our eyes peeled. Again, this is something I'm going to be talking about in the coming weeks. Like I said, tariffs, we're not out of the woods yet. A 90-day reprieve is only 90 days, right? Things could change in those 90 days. There might be more talks after the 90 days. So we'll just always continue the conversation. So thank you so much for tuning in today, and I look forward to seeing everyone next week.